War is horrific, and besides the innocent victims of violence, there are trickle-down effects into other parts of life, like housing. We thought we were almost through the worst of the housing market. In just a few more months, many people expected rates to start trending down, and finally, regular people could buy homes again. Millions of people would like to buy a home right now, but they can't. The median priced home in the US for someone who needs a mortgage will cost almost $4,000 a month because of today's interest rates. Just when we thought things were going to get better, war breaks out in the Middle East. Housing prices are local. They don't move too much based on international events, but interest rates? Instability like this can have a big impact on mortgage rates. But which way are they going to go? Up or down? In today's video, we're going to look at 3 conflicting opinions about what's going to happen. Then I'm going to share a conversation I had with my preferred lender, Brandon Kelly at Cross Country Mortgage. We talked about the 2 things that are impacting rates right now in regards to the Middle East. I'll be honest, we didn't really agree with each other about what rates are going to do, but then he shared a specific resource that he looks to when he's not sure, and he definitely gave me some hope about where things are going. First, let's look at the opinions. This week, Janet Yellen, the U.S. Treasury Secretary, said that it's really too early to tell what the impact of the conflict will be.
I think it's too early to speculate on whether or not there will be significant consequences. I think, importantly, it depends on whether the hostilities extend beyond Israel and Gaza, and that's certainly an outcome we would like to avoid.
Larry McDonald, author and founder of the investment advice Bear Traps report, thinks Yellen is not telling the truth. He said, "You could say it's irresponsible because she's not being honest," McDonald said. "At the end of the day, this is a conflict that really the probability that it goes away in a short period of time and the probability that it doesn't escalate is low." McDonald believes that the Middle East conflict is one of the 3 elements that will stop the Fed's rate hikes in their tracks and that they'll be forced to cut rates by next year.
The banks are stressed. At the same time, we have this massive stress in the Middle East. We have a government shutdown potentially for November 5th, 17th. So those 3 things are going to stop the Fed. The Fed is done, and they probably hike rate. They probably cut rates by 100 basis points by next July.
But David Russ at Schroders disagrees with that outlook. He sees the conflict creating higher oil prices, fueling a wage price spiral, which will make the Fed keep rates higher for longer. He wrote, "Higher commodity prices, oil prices going up because of the conflict, lead to an increase in inflation, while the risk of second-round effects, i.e. rising wages and prices, against a backdrop of tight global labor markets would tip the balance at central banks towards some additional rate hikes. Those lingering concerns about ingrained inflation would also delay the eventual pivot to rate cuts until later in 2024. This would all result in slower growth, creating a stagflationary outcome." Stagflation is a scenario where there's high inflation and high unemployment in an economy that isn't growing. So in that scenario, homebuyers will continue to deal with higher rates for longer. Now let's look at my conversation with Brandon. The first thing we talk about is that the initial reaction to unrest is generally going to be investors moving their assets into safer investments, and that usually means mortgage rates go down.
I'm trying to advise people on whether they should lock or float. I'm trying to advise people on whether or not they should, consider sitting on the sideline or getting into the market. Over the weekend, conflict really picked up over in the Middle East between Israel and Palestine. And conflict tends to push people from things like the stock market and riskier investments into bonds because they're much more stable investment. So the price of mortgage bonds impacts the interest rate on bonds. When conflict stirs up like this and it gets more serious, we start to actually see improvements in rate. And we saw that Monday.
It came down. Last time I looked, it was 7.87. That was like last week. I think it was like Friday.
That's correct.
And today it's 7.6 on Mortgage News Daily, it did improve a little bit, which is good.
Today we get news about the bond auction. We get news about inflation. So we got a very high number, unexpectedly high number for inflation coming out today. And on top of that, the mortgage bond 30-year auction went very, very poorly, showing just, a low appetite for bonds in this market. And so
so what does that mean? What is a low appetite for bonds? Investors usually buy bonds when things are a little unstable, so they want a more secure investment. Is that correct?
Yeah, correct.
And so we were expecting more movement into bonds and we didn't get that?
Correct. Yeah, it did not go well.
However, investors weren't as motivated as we expected them to be to choose safer investments. But the other thing that happens in these kinds of situations is market volatility, which means things can change.
There's just so much going on in the market. And again, so much volatility. In this market, you see 30, you see 50, 60 basis points of movement on a daily basis. A normal market, you would probably maybe see 6 to 10 basis points of movement throughout the day.
Holy, that's crazy.
So it's tough to keep up with, and again, you get a little news one day and it does this giant reaction in one direction. The next day you get completely different news, goes the exact opposite direction. And when we have large, global conflict like we have here in the Middle East, that could have, that one element that could have such a large impact on what the Fed decides to do and what the future of bonds looks like and interest rate, down the road.
So what are a couple different ways that it could go?
So there is the issue of inflation, and that really seems to be a big drive for the Fed. They can continue hiking rates and keeping rates high in order to bring that down. They keep saying they've got a target of 2% inflation. They may decide to just leave rates high. They may decide that we have to get back to 2% inflation. If they believe the economy is strong and holding well with high rates, well, they're gonna keep them high. But the second that they start to see issues with the economy and they start to see that certain sectors are falling apart, that's when they start to make decisions on stopping, slowing down, or going in the other direction and lowering rates.
What about oil prices? I mean, oil prices have a significant impact on inflation. And that's kind of my biggest concern with the Mideast is oil prices. We've had a hard time getting those under control. We had just struck a deal with Saudi for them to supply some crude oil for us to help us get our oil prices under control and hopefully get our inflation under control. I think that's going to have a significant impact. What do you think?
I look to larger entities, people that do make these decisions, like banks, like Fannie Mae, Freddie Mac, that every day they have to set their rates, they have to set their pricing. And so there's a lot of major banks, Goldman Sachs, the Mortgage Bankers Association, Fannie Mae, Freddie Mac, a lot of large entities came out in the last 2 months, and everyone's projections pretty uniformly have been that we see rates come down to, say, 6% range at the start of 2024, and just kind of slowly going down throughout the rest of next year. Those projections, they haven't been accurate so far this year. They haven't been right. They've kind of most banks, most entities thought we'd see rates start to come back down in the middle of summer. We didn't see that.
I feel like economists look too much on numbers and not enough on behavior. You can't just fix a problem like this by upping and downing rates, in my mind. You have to fix the underlying, issues that are causing them,
The Fed is very reactionary. The Fed is they're not super proactive, and they typically respond to the data that they're getting as opposed to start to make decisions prior to there being an issue. So I think what you're going to see is a lot of these issues kind of coming to a head in some way before they start to go in the other direction. They held rates down for so long until it was a problem, and then they had to slingshot in the other direction. I think that's what we see with the rate drop. I think that they're going to keep them too high for too long until they're forced to have to bring them down. And then it's going to happen very quickly.
What is the impetus to believe that rates will get lower than a 7% or a high 6s or something like that? Like there is no, what's the normal rate? What's considered normal?
If you look back 30 years historically, in the 90s, rates were in the 7s. Into the early 2000s, they were in the 6s, 5s and 6s. And then we saw 4s as a norm from about 2012 onward. So it's been 10 years. I mean, there's a whole cycle essentially of home buyers that are not.
But does 10 years make norm? Does 10 years make a standard? You know what I mean? That's my question. I don't know that that's the case. When things are hard to predict, a good place to look for guidance is to follow the money. We can learn a lot by looking at what banks are doing with their money.
I'm gonna go back to and reference back to the point that I had talked about earlier with the banks, with Fannie Mae, Freddie Mac. So one thing that most people don't see that I do, so I'm a loan officer. I write loans for the bank. I price out loans and I lock people. I set the terms for loans. I don't create the rate. My bank does not set the rate. Fannie Mae, Freddie Mac, they do nationally, but There's an interesting thing going on that I usually point back to, and it's that Fannie Mae and Freddie Mac, the way they are pricing their loans, the way that they've set up their pricing, they are actually forcing a lot of buyers to pay upfront fees. When they go ahead and they write a loan, right now they're having to write loans in the high sevens. They're having to write loans in the 8% range. They have to back that up. Well, the bank ultimately makes money on the interest payments that you make every month. And so if they write you a loan, and let's say it's 8%, and you refinance that loan maybe in a year, the bank didn't really make any money off of it. And so what they have to do is they actually have to hedge. And they're requiring people pay upfront financing in the way of discount points because they won't write the loan without points in certain cases because they believe that rates go down.
Refinance it. Yep.
Exactly.
That
and
makes sense.
So I kind of point back to that a lot because it's, these every day they've got to make that bet, and every day they have to sign that check. They have to write those loans. And the way that they're pricing right now suggests that they don't expect you to have the loan for very long. They obviously want people to get loans. They want to write loans for people. It's how they make money. And they know when they put a lot of upfront financing in there, people are less likely to qualify and less likely to move forward with loans. And so they're having to make that hedge. And right now they're betting that these loans are not going to last for very long and that you're going to refinance them.
That's a really good point. Let me simplify what he was saying about banks because it's a big deal. Banks have a problem. If they charge too many fees, people won't get approved for the loans and banks won't make money. But if they don't charge the fees and people refinance within a year or so, they won't make money. So they have two risks. Choosing to charge upfront fees, even though it eliminates some people from the buyer pool, tells me that banks believe pretty strongly that people buying right now are going to refinance in less than a year. They think rates are coming down. Now, as Brandon said, they've been wrong this whole year about what rates are going to do, but the longer they're wrong, statistically, it becomes more likely that they are right this time. Even a broken clock is right twice a day. If you'd like to sign up for my newsletter or check out my incredible website for people moving to Raleigh, there are links in the description below.